We continue to favor equities over fixed income for the next 12 months for three key reasons. First, business cycle remains positive, and we see continued growth in the global economy, though the growth is likely to be less synchronized in 2018 than it was in 2017. For example, while Eurozone is generally doing okay, all indicators in the US are pointing towards a continued expansion and very low probability of a recession. Second, global corporate earnings continue to be strong with positive momentum. They're also very broad-based, so across different countries and different sectors. And thirdly, financial market conditions remain stable. There are little signs of stress in the banking sector or the credit markets. We also closely monitor market risk, and current level of risk are fairly low. So despite the market correction that we had earlier in the year, we don't see a bear market in the next 12 months. We think currencies with better relative growth and real rates will outperform, and that's why we like US dollar. What's holding us back from a full overweight position in equities at this time is the fact that we're in a rising interest rate environment. Real interest rates have been rising gradually as inflation expectations continue to recover. We think financial market conditions will continue to gradually tighten, led by the US interest rate hikes. However, interest rates remain low structurally, so we think we're still in a positive environment for equities. We're also keeping a close eye on international trade, as the talks of a potential global trade war continue to heat up. Any material disruption to global trade could have a negative impact on global growth and on our view on equities. At this point, the tariffs that have been announced will have a small impact, but this is an issue that we're going to be following closely, as any changes could have a significant impact to our outlook.